I'm going to talk to you about delta. Delta is basically the chance.
The reason why every single covered call ETF loses money. And the reason is that you're sacrificing the upside while you're also assuming a tremendous amount of risk on the downside. I would not recommend the strategy at all.
Of it being at or above your strike price before expiration date. Well, if we go down here, we see this beautiful call that we have at 260. We've got a 75% because it's got a 75 delta of that being above $260 before your date, right? Well, it is today, so we already know that. But as the time goes by, that 75 is going to go up as long as this stock continues to stay above 260. It's got to go down by about 30 points, 28 points or so to get down to that 260. Well, a lot of stocks could do that, but stocks have a tendency to stay where they are within a little bit of a range. So the farther you go from that range, the chance that you have it. As this stock stays above 260 and as the expiration approaches, you end up making, you got a 75% to an 80% to an 85%. By the time it expires, you got a 100% chance of making this juice. Now, wherever the stock is, you're going to get the in the money amount. So if the stock is at 261, you're only going to get have to pay $1 of in the money amount, right? But you've got $10 of this. And by the way, your base position, whatever it is, a stock or the deep in the money option, that moves up in this case by $1.
All right, let's briefly take a look at it. So remember, he got $38 on this, and it looks like he sold it in the beginning of May. It is the 260, June 6th. So June 6th, 260. If I was going to buy back that call option, he got $38, and now it's trading at $80. So that's a difference of $42, meaning that this option is trading for $42 more than you sold it for in early May 2025. The issue is that if you purchase this stock at $287, then your maximum profit is going to be $10 a share. So if you have 1,000 shares, then you've made $10,000. However, had you done nothing and simply purchased Tesla at $287, then you would be up $53 a share. That's $53,000 versus $10,000. So by selling that deep in the money call option, you cost yourself $43,000 in potential upside.